And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it's Tuesday as we get kind of rolling through this week. And today, big earnings, right? Microsoft reports after the bell today. So again, now we're into this week and next week. We're going to get the majority of those big mega cap companies coming out, Microsoft, Apple, etc. Netflix kind of paved the way earlier with their report. Of course, that was good, but what's interesting is that now it's going to be about how the market responds to these really big companies like Microsoft, etc. So this is going to be kind of the market moving data over the next couple of days, and we'll kind of continue. We'll update you on it as it goes. But we're getting into the heart of really this, of the S&P 500 and earnings. And by the end of next week, we'll have about 80% of the S&P 500 will have fully reported, and so we're going to have a really good measure of just how good earnings were this season or not, right? So, so far they're about as expected. And that's, of course, not surprising. Remember, I told you, and we reported on this previously, is that in the month of November and December, we cut earnings estimates by more than $8 a share and are down markedly from where they were when we first had the end of the year 2023 estimates. So, that bar was put really low, and so far right now, companies are meeting expectations, but they're not really blowing the door off in a lot of ways. So again, markets are doing okay here, and we'll talk about that in a second. But this is something that is going to be more important as we go forward, and particularly as we talk about valuations in greater detail. And that's really the subject of today's show, is that we're going to talk a little bit about valuations and how this relates to George Soros and his theory of reflexivity. Now, I'm not a fan of George Soros. The guy's pretty evil, but he reminds me of Spectre in the James Bond movies. Has a little cat and everything. So anyway, but the theory of reflexivity holds, is interesting. And I got an email about this a couple of weeks ago, asking about it. So I've written about it before, and I just thought it was a good time considering what's going on with AI and this whole chase in the markets. It was a good time to kind of revisit that theory and look at valuations and kind of what happened. So we're going to talk about that in the show this morning. So stick around for that. Also got a couple of other topics to get into as well. But the big news this week, of course, is going to be Jerome Powell on Wednesday as we get the first meeting of 2024 out of the way. Will they cut rates? And more importantly, are they going to allude to rate cut, more rate cuts this year at a sooner pace? Right now, it's kind of expected that the Fed may not cut rates until later this year, but there's a lot of hope by the markets that if the Fed's going to cut 5 to 7 times this year, now remember the Federal Reserve is only talking about 3 rate cuts this year in terms of their projections. But if they're going to cut 5 to 7 times this year, which is the expectation by Wall Street, we're going to have to start moving those rate cuts up as soon as March, maybe even at this meeting on Wednesday. We'll see. There's a very low expectation of a rate cut this Wednesday, but there's an increasing level of hope for rate cuts coming as soon as March. So again, that's going to be the big driver of the market, of course, as we kind of go forward. And again, because that's been the case, we don't really look at valuations and fundamentals. We just worry about what the Fed's doing. Right now, futures are pointing a little bit lower this morning. Bonds had a really good day yesterday. Had a nice pop in bond prices coming off support. Remember, we've been talking about how bonds were oversold and looking here for a bounce. That bounce came yesterday on the back of an announcement from the Treasury that they will need to be not issuing as much debt on a net basis. So that was good news. We're still going to issue about $700 billion worth of bonds, but it's less than what people expected. So hey, you take what you can get. The bond market liked it yesterday as well. But here's what you need to know before the bell this morning. Guess what? Market set another new all-time high yesterday. Once you this is always funny because every day the market's an all-time high. We get it's the 5th all-time high in a row. Well, yeah, once you've set the first all-time high, any day you go higher, it's going to be a new all-time high. So it's the 5th all-time high out of 6 days. Okay, well that's fine. Yeah, markets are going up. As we've talked about here recently, markets are getting pretty overbought here. But again, we still have buy signals in place. They are very overbought on multiple levels. The market is overbought on multiple levels. But again, that certainly doesn't, dissuade people from chasing stocks. Once you have momentum behind the market, that can certainly continue to drag on here for a while longer. But the markets are now trading at basically starting to push into 3 standard deviation territory above the 50-day moving average. Again, that's not uncommon. It can do that. We saw this previously. The market pushed up here and then just kind of went sideways here for a good bit of time. The one thing to note about this is that just because you get really overbought, it doesn't mean you have to have a correction. It can mean that you can just have a long period where the market really doesn't do a whole lot. In other words, that upside to the market becomes a bit more limited. And that's kind of where we're getting right now. Again, we're kind of pushing up to this very high level. Market is advancing, but it's having a tough time advancing. So that's that overbought condition kind of weighing on the market because buyers and sellers are pretty much matched here at this point. So once we get into February now, February tends to be a little bit weaker month overall. We're likely going to get some type of pullback or a correction simply just because of the deviation that we now have, as we talked about this yesterday, between moving averages. We're just, really starting to stretch that rubber band a bit. So as we said yesterday, this isn't surprising how the market's doing, but this rally that started back in October of last year is getting very, very long in the tooth. And again, it's just one of those periods. We talked about buying stampedes and selling stampedes previously, and we're just in one of those buying stampedes at this moment, which is lasting for a fairly long time, and that can certainly occur. But we're going to go through a period where we're going to work some of this off. So as we've talked about, there's really nothing to worry about here to any great degree, but it's certainly worth, considering holding a little bit of extra cash, maybe not putting a whole lot to work all at one time. Because again, it's just you're gonna get a better opportunity to put that capital to work. You have to be patient, and again, the problem is that's hard. I get that because every day it's Nvidia's going up or Microsoft is going up or whatever it is. Like, oh, I'm missing out. You may get that pullback at some point and wind up paying more for a position than it's currently priced at today. But the risk reward at that point will be better than it is today. And that's the hard thing for people to understand is that, if I'm buying something, if I can wait for a better entry point, I may actually pay more for it on a price basis, but that risk reward will be better when I do that in my portfolio. So again, just something to consider. Markets are fine. There's technically nothing wrong going on, and there's certainly nothing that suggests that as we kind of look at the markets itself, that we need to be concerned about things. But it is worth, paying attention to what's happening in some other areas of the market as well. Gold prices have pretty much stagnated here. So, there was a lot of expectation that there was going to be a big run in gold earlier this year. That really hasn't matured out just yet. We'll see. We'll keep a watch on that. The kind of the big thing to pay attention to is volatility, which remains very suppressed. We're at levels that have typically preceded market corrections of some sort. And again, we're not talking about major corrections of 15 or 20%, but with volatility as suppressed as it is, there's absolutely no concern about a market correction right now, which is, as they always say, it's what the market's not expecting that tends to happen. You've got a good setup here for a bit of a pullback in the markets, in February or at least in March. So again, this kind of goes back to the overall view of just be a little bit patient here. Let the market come back to you. You'll get a better opportunity to put capital to work. Okay, that's what you need to know before the bell this morning. When we'll come back, got a few things to talk about. One of the issues is that Congress is already starting to push on Powell to make housing more affordable, but that's exactly why housing is not affordable. We'll talk about that after the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So we're going to talk about George Soros' theory of reflexivity here in just a minute, but I wanted to touch on this article I saw on CNBC yesterday. Came out late afternoon. And, it's interesting because, we have a lot of conversations, not just here, but, in the media. You hear it a lot. It's about housing is so unaffordable. Nobody can afford housing. I saw an interesting stat out this morning. The size of houses are getting smaller. So for the first time in, decades, we are now building smaller houses on average than we did before. We got up to about 2,500 square feet was the house. And so going into 2008 and really beyond the financial crisis, we were increasing the size of the houses we were building. So the average house, square footage was getting larger and larger. We got up to like 2,500 square feet. Now that's been coming back down. We're now building smaller houses to try to, get them to be more affordable. And of course, we've had the advent of tiny homes, et cetera, because people just can't simply afford to buy a house. So if, for a cool $250,000, you can get a 1/4-acre lot and a 600 square foot house, right? So, and this is, all a function of a lot of this, problem that millennials and Gen Zs have, and part of their anger is they just can't afford anything, the cost of rent, et cetera. I saw a really interesting stat out the other day. There was a young, and just a kind of an example, it was kind of a young Gen Z guy on social media, and he was talking about, back in the day, right? Back when boomers were growing up and Gen Xers, you could live on $30,000 a year. And there's some truth to that, right? But he made the mistake of saying, oh, they were comfortable on $30,000 a year. And that's a huge measure of subjectivity, because when I was I'll just tell you my life growing up. My dad made $30,000 a year. He was a warehouse manager for Dow Chemical, managed the Versine plant, made $30,000 a year. We lived in an 1,100 square foot house with one window unit in the house. Brent's over here nodding his head. We had 1.5 bathrooms in the house and a yard. And there was no extra money at the end of the month. Now here's also some other big differences between then and today. Everybody in the household didn't have $1,000 iPhone and a $100 a month cell bill or whatever it is, right? We didn't have internet bills. Every person in the house didn't have to have a laptop or an iPad or whatever it was. Mom and dad weren't having to run kids all over the place to go to birthday parties at, the iFly or the jump place, whatever it is. They weren't having to take them to sport, drag them all over the town to go to, different sporting events and this and that and the other thing. You got home from school, you got on your bike, you went outside, and parents didn't see you until you got home, when the streetlights came on, right? Vastly different. But there was not a lot of extra money. I can tell you the story. I can tell you the story because my father's dead. He passed away a few years back, so they can't arrest him for this. But I will tell you that more than once in my life growing up, I was the kid holding the flashlight at the kitchen table as my dad took the electric meter off the house and ran the meter back before the meter reader came. Because ends were tight, right? Had to make ends meet.
That's when electricity was cheap.
That's when electricity was cheap, right? Gasoline was $0.25 a gallon. So, it's a big myth that, back in the day, people lived comfortably on the salary they made. It's, times are no different. And people are making a lot, the average salary today is $60,000 to $65,000 a year. And, yes, the cost of living is much higher, but there's also a lot of changes to that cost of living that are incredibly important. We believe that we need $1,000 iPhone. We believe that we need internet. We believe that we need all these things. And the real question is do you need them or you just want them? Because those are big differences. I'm not saying that, these aren't choices that we can make or not make. I'm just saying there's big differences between growing up in the 70s and growing up today. And so I get it. I do understand. And the cost of housing has certainly gone up, but the cost of housing has gone up markedly because of the Federal Reserve. And it started with Alan Greenspan back in 2000 when he started pushing adjustable rate mortgages. And that was back, pre-2000, in the last century, you had to have a 20% down payment to buy a house. And the housing market lobbied Congress and they said, we're not selling enough houses. We need to sell more houses. And we can do that if we can get past this 20% down payment. So we came up with adjustable rate mortgages. We came up with ways to split mortgages. So you could do an 80% mortgage, one and do another 20% mortgage and get past the PMI. And there was all this other stuff, right? And then, of course, that evolved into ninja loans and no income verification loans and, vast majority of mortgages that went belly up in 2008. But because of demand, right, housing prices went up. And I thought it was interesting yesterday that our politicians don't learn ever. Of course, you also have to look at the politician, but it's Senator Elizabeth Warren back in action. She was meeting with Chairman Jerome Powell yesterday of the Federal Reserve, and she was pushing him to cut rates. Elizabeth Warren and three other Democrats urged Fed Chair Jerome Powell to bring down interest rates at the upcoming Fed meeting, the one this Wednesday. And here's the funny part. Why does she want him to bring down rates? To expand affordable housing. Now, let's think about this for a couple of seconds. If you want housing to get cheaper, what do you need to do? There's only two options. Because the only way to bring down housing is to cut demand. So either I need to provide a lot more supply to exceed demand so that prices will come down, or I need to make the pricing of the houses so high that it cuts demand to the point that supply exceeds the demand and prices eventually come down to meet actual demand. And so we actually kind of did that, right? So the Fed hikes interest rates. It makes housing cost a whole lot more. And guess what happened to housing prices? They started coming down. But they're still too high. And now what we want to do is cut rates. Now, if I cut the mortgage rate, because the Fed cuts interest rates, what happens to housing prices? It doesn't make, just because the mortgage rate comes down, it doesn't make the housing the housing more affordable, because what happens? Housing prices go up. I create demand by lowering the mortgage rate. So what Elizabeth Warren is saying is like, I need you to cut rates so that we can make housing more affordable, but you're not going to make housing more affordable. Yeah, you will cut the rate, but you will drive housing prices back up again. If you want to bring housing prices back down to a level of reality, there's only one way to do it. And it's painful. You have to get rid of 3% mortgages from Fannie Mae and Freddie Mac. You got to get rid of all this other nonsense in the market. You got to go back to a 20% down payment. That's it. And yeah, it's going to absolutely suck. Nobody will be able to afford a house for a while. People will have to rent for a while. And when the pressure builds on the housing market, they will stop building supply. Prices will come down on existing supply to get it moved. But until you realign supply and demand, prices of houses are going to remain astronomically high, because we keep doing all this stuff under the premise that everybody needs to own a house. Why does everybody need to own a house? And I won't even talk about the other problem that we have with the housing market, which is corporations. We'll talk about that some other time. I have a solution for that problem too. But we have this idea in America. We promoted this idea, and it wasn't we. It was the National Association of Realtors and Home Builders, that everybody needs to own their home. And look, it's a great theory. But in reality, there's a lot of people that don't need to own a home. They don't need that expense. They need to work on the other stuff in their life to get financially sound first, to where they can afford a home. A home is not an asset. It's an expense. Ask any homeowner that has to pay taxes every year. Homeowners association dues, maintenance, upkeep. Ask Danny, whose washer just flooded his house and he's having to repair everything. It's an expense. And Elizabeth Warren is not going to make it any better for you. All right, quick break. We'll come back, talk about the theory of reflexivity with George Soros. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult.
There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisor's Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife loves true crime. We're at home watching a show last night, and the guy picks up his phone, and on his phone is a text message, and the letters are just huge, And she's like, "Why is his text so large? Mine aren't that big. I can't even read the text on my phone."
The Real Investment Show podcast.
I said, if you just click on a text message, you can expand it. She clicks on the text message, and she's trying to expand it, and she goes, "Mine doesn't work that way." And I said, "Honey, yours is already expanded as far as it can go."
At realinvestmentadvice.com.
My wife loves true crime. She's been plotting to kill me for years.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and Lunch and Learn replays, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
I was just watching headline news while we were on break, and there's a lot of division in this country politically between the right and the left, right? And a lot of people don't identify with any party anymore. So over the weekend, I was thinking about starting a new party. I was going to call it the Patriot Party, right? I went and looked up the Patriot Party. It's a failed attempt at a socialist party. So why is it that people are always ruining good names? That's all I want to know. You come up with a really good idea, somebody's already messed it up. So anyway. So let's talk about George Soros here. And again, not a fan of Dr. Evil, but he has look, he's done well investing over the years, and he's taken control of countries and a whole variety of other issues. But he came up with a theory called the theory of reflexivity. And this theory tends to populate every time markets get into more exuberant stages as they are now. And it was interesting. I got an email asking, about this theory of reflexivity and what that means. And, is it a valid theory? And yes, the theory is very valid. And, the email I got was from one of you listening to the show, and I appreciate you listening to the show. By the way, if you're on the channel right now, be sure and like and subscribe. We appreciate it. It helps us with the Google. I'm not a fan of Soros, but this market has the look and feel of the dot-com bust in 2000. In a few short words, the AI investment phenomenon is feeding on itself just as the internet and fiber did in 1999. That's a true statement. There are some differences, right? between now and then. But I mean, if we just take a look at, I did a chart. I just, threw up a chart of the AI, run so far, and the 2000. We haven't had the crack up boom just yet, but it's working its way, right? So there's some similarities to kind of what we saw in 99 heading into 2000. And, there is a difference, of course, that is important, because that difference is that a lot of those companies back in 1999, 2000 didn't have any earnings or revenue. Right? I mean, we go through the list, pets.com and a whole bunch of others that, they just had no revenue and no plan. But today, a lot of those companies have revenue, but the valuations that we're paying on them are just astronomical. I did a list of the companies in the S&P 500 that are trading at price to sales ratios of more than 10x. So this is an important point, and we've talked about Scott McNealy before. When every time we talk about price to sales, we refer back to Scott McNealy because he may have the best explanation about this. But basically, a company can't support 10x revenue or 10x sales. And so in the S&P 500, there's 91 companies that are trading at very high levels. There's 100 and let me make sure I just have my number right. I just want to say this. Yeah, there's 136 that are trading above 5 times price to sales. That's 25% of the S&P 500 trade at price to sales ratios of greater than 5x. 2 times price to sales is expensive. You've got to grow revenue at 20% annualized. Leave that chart up for a second, Brent. You've got to grow sales at 20% a year to maintain your price trend and at a price to sales ratio of 2 times. And yet we've got companies like Microsoft trading at 13 times price to sales, NVIDIA trading at 33 times price to sales. I sorted these by market cap. But you can just go, and the ones in yellow are the ones that are most popular right now, that people talk about all the time, and the ones that are kind of mostly in that AI space. But the level that these stocks are all trading at is not sustainable, right? Now you can go. Now you can. We're going to go to the next chart. And so, as I was saying, is that at 2 times price to sales, let's just talk about Apple for a second, because, it's in one of everybody's darlings. It's in the FANG. And here's a company that trades at 7-8 times price to sales and has not been growing sales on an annualized basis for a very long time. And again, just to maintain a growth rate of 2 times price to sales, you've got to be growing your sales at 20% a year. So when you're at 5, 6, 7 times price to sales, you've got to be growing sales at 100% a year. And Apple's not doing that. And that's the reason that the price to sales ratio keeps going up, because the price goes up, but the sales aren't growing to keep up with that increase in price. And it's the same case for a lot of these companies. The sales are growing. They're just not growing fast enough to keep up with the price appreciation. In other words, investors are paying more and more and more and more for every dollar's worth of revenue. And it's just not growing that fast. Go back to that chart, Brent. And so what's important about this chart is if you look, so the S&P revenue growth is red. That's the annual rate of growth in the S&P. It's trending lower as well. So again, this is where we are today. Now we can go to the next chart, Brent. But this is where we are today. You just quit clicking off my chart till I'll tell you. I'll say next chart. But this is where we are today because, we just continue to pay more and more and more for every dollar's worth of sales, right? On expectations that eventually sales are going to catch up with revenue. But see, the AI boom that we're having right now is not new. We go through these booms all throughout history. These revolutions. Oh, this is a new revolution. This is the AI revolution. Yeah, maybe, but we've gone through all these before. We went through the internet revolution in the late 90s. We went through the computer revolution in the 80s and the early 90s. And then we went through the great generation space exploration revolution in the 50s and the 60s. We went, in the industrial revolution. So you go back, and we always have new revolutions coming along, and we wind up getting all excited about them. We wind up overpaying for them, and then we go through a long period of working off that excitement. And so this one will likely, be no different. Go to the next one. Than in the past, and this is the problem right now, and this is this is the theory of reflexivity. Let me read to you this from George Soros himself about the theory of reflexivity. First, financial markets far from accurately reflect all the available knowledge, always provide a distorted view of reality. The degree of distortion may vary from time to time. Sometimes it's quite insignificant, at other times it's quite pronounced. When there is a significant divergence between market prices and the underlying reality, there is a lack of equilibrium in conditions. So I've developed a rudimentary theory of bubbles along these lines. Every bubble has two components: an underlying trend that prevails in reality and a misconception relating to that trend. When a positive feedback develops between the trend and the misconception, a boom-bust process is set into motion. The process is liable to be tested by negative feedback along the way, and if it's strong enough to survive these tests, think 2022. Both the trend and the misconception will be reinforced. Think 2023. Eventually, the market expectations become so far removed from reality that people are forced to recognize that misconception is involved. A twilight period ensues, but the prevailing trend is sustained by inertia. Typically, bubbles have an asymmetric shape. Okay, we're going to get into this in a second, but here's the point. I want to come back to the asymmetric shape part. Right now, we're in the heat of the moment. And so people don't care about silly things like valuations. I need the chart, Brent. Equity risk premiums, and revenue growth. Equity risk premiums are falling. In other words, people are wanting to pay more and more and more, take on more equity risk relative to the premium they receive. This is typical of what happens when you get into a asymmetric bubble type market. So we're willing, and again, investors are taking on more and more risk with less expectation of return. So this is, and so now let's go back to this last statement from George Soros talking about typically bubbles have an asymmetric shape, and this is what an asymmetric shape looks like, just scientifically. You have this, this surge that runs up, then you have a big kind of decline, and then the market goes sideways for a long time, and then it runs up again. This is the asymmetric shape, right? And so have we ever seen this shape in the markets previously? And of course, the answer is clearly yes. It may take Brent a second to get this chart up, so give me just one moment. But this pattern, this asymmetric pattern, appears regularly throughout history going back to 1900. We saw it back, in 1900 through 1917. We saw it, of course, in the bubble in 1929. We saw it going into the 60s, in the early 60s. We had the same type of event. Of course, the crash in 74, the dot-com bubble, the financial crisis. If you take a look at where we are right now, we're clearly in that same upward movement of that asymmetric shape. The question, of course, is what triggers the decline, right? That's the question we don't know yet. All right, we'll come back, finish up this conversation. This article with all these charts, if you want to go kind of read through it and get all the explanations, on the website now, realinvestmentadvice.com. It's called Soros and the Theory of Reflexivity. It's on the website, realinvestmentadvice.com. We'll be right back.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
You're listening to The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
Welcome back to the show. I just want to finish up talking about this theory of reflexivity and you know, kind of the making of bubbles. And you know, it's always very dangerous to say, oh, well, we're in a bubble right now, because you never know you're in a bubble till after the fact, right? But there's certainly some similarities between what's happening in the market, kind of the greed, the speculation, et cetera. That's certainly reminiscent of previous bubble periods in history. And no, we haven't done anything yet to correct that. So, Brent, can you bring that last chart back up again real quick? Yeah, that one. So you'll notice that, you know, beginning in 2015, this market's been in an accelerated advance, and we have not done anything to correct that trend channel yet, right? That trend is very, very elevated, 40, you know, probably a 50-degree slope higher at this point, 60 degrees. So again, you can just draw a line right across the bottom of that 2015 to present period. So we have not done anything at this juncture to reverse that at all. And again, you know, what's important is understanding the dynamics of why that happens. And again, so we go back to the theory of reflexivity, is that we have this combination of misconception and trend. And right now, everybody believes the misconception, and that this is going to be the game changer and everything else, right? Which is fine. And that misconception leads to the other problems about valuations and price. So we take, and so again, misconception is all sentiment, right? The representations of sentiment are valuations and price, because those are the reflection of sentiment. So the more willing, you know, if I'm very bullish, I'm willing to pay more for stuff. And so if we take a look at the deviation of valuations from their long-term exponential growth trend, you know, we're paying some of the highest levels in history right now relative to that long-term growth trend in valuations. That's a reflection of that kind of bullish exuberance. But we also see this reflected in the price of the market itself. And we can do the same analysis and just look at the deviation of the price of the market from its long-term exponential growth trend. The market should grow over time relative to economic growth, right? There's a correlation between those two. So if you have big deviations from that exponential growth trend, that's typically aligns with bubblicious periods in the market. And we certainly have that same representation today. So again, doesn't mean the market's going to crash tomorrow. That's not the point that I'm trying to make. I'm not trying to make the case that, hey, we're in a bubble, market's going to crash tomorrow, you need to go hide out somewhere. I'm not saying that at all. These things can last a very long time. We're 13 years into this secular cycle, and they can go another 8-9 years. These things are very hard to change. These ideas, these sentiments, these misconceptions can last a lot longer than you expect. And momentum begets momentum, right? But it is, an interesting discussion to have when you start looking at the theory of reflexivity and kind of the relation to where we are in the markets today and past periods in the markets. And so you see that same pattern develop over and over and over again throughout history. And it tells you that at some point there will be a reversion to ultimately rebalance price and valuations. As we always say, is that in the short term, nothing matters but momentum. But in the long term, valuations matter the most because what you pay for is what you get. And so valuations will always, at some point, reflect reality. But that can be years. Markets can remain irrational a lot longer than you can imagine. We've seen it in the past, right? We saw it in the late 90s. Market was just going up and up and up and up and up. And they can do that. And we come up with all new reasons to justify these exponential market movements that we have. Oh, well, it's AI. It's going to change the world. The internet was going to change the world. The internet did change the world, right? Market still crashed. We've had these revolutions all throughout history, and yeah, they revolutionize the ways that we do things. It changes the world. But eventually, markets have to reflect reality. Because what we pay for is we pay for earnings growth, we pay for expectations, we pay for those things, and at some point, those have to align with some level of reality. But again, that doesn't mean anything about today. That doesn't mean that tomorrow morning you're going to wake up and the market's going to be down 50%. I'm not saying that. Don't take away from this conversation that I'm saying that, because I'm not saying that. The whole point of this article is just the thought process. It's just to get you to think about where we are and what we're paying for and what we're doing. And again, this doesn't mean to go out and dump all of your AI stocks, right? Look, we're long Microsoft, NVIDIA, AMD, Google. We're long Amazon. We're long all the quote unquote AI stocks. Because we have to be, because markets are going up and we need to make money for our clients. We just like every other portfolio manager on the planet does our best to track our index. So if the indexes are going up, we need to be making money for our clients. Where our test comes in is when markets are going down. And that's where we have to be quick on the trigger to start reducing risk and rebalancing portfolios, et cetera. And we try to do our best, but we have no crystal ball, just like anybody else does. We had the economic summit this past weekend. Great turnout. It was a lot of fun. As I said, we enjoyed meeting everybody that came. But one of the things that I was talking about there is that we're talking about the best predictors in the world are meteorologists for 3 days, and yet, as investors, we think we can see the future decades out, and that's just not true. When something changes, and it will change very quickly. The problem is just knowing when. It's always the timing. We touched on this a little bit yesterday. Markets are really good about reflecting environments. And so, I get a lot of emails from people, well, what about the dollar? What about the debt? What about all this other stuff, right? What about, what's happening in Iran right now? The market knows all this. The market doesn't care about this. All the market cares about right now is the Fed. The market's banking on the fact the Fed's going to cut rates. At some point, there could be a risk there because there's a deviation between the expectation of how many times the Fed will cut by the market and what the Fed says. Somebody's wrong. But all this other stuff is already factored into the markets. You will know when something's not factored into the market because you will wake up and you will turn on CNBC or whatever your channel is that you watch for finance, and you're going to look over there at the futures, and the futures are going to be down 3 or 4% in the morning. Dow's going to be down over 1,000 points. And you're going to oh, what just happened? And there's going to be a race for the exits. That's the event the market was not aware of. That's the market that has now caused investors to rethink what they were paying on valuations. If you read a headline or somebody puts out some video about, oh, you better head for the hills because, the dollar's about to crash, and the market's up the next day, it's not the thing. The market's going to price it when it's something that's unexpected, and that's all you need to know about. All the other stuff, just put it in a box. I'm not saying it's not worth paying attention to, but the market's not paying attention to it. The market's already factored it in. The market already knows about it. Because you got to remember that no matter who your favorite guy is, or girl, whoever it is, who your favorite person is out there that you want to listen to for financial advice, etc., they only know what they know, right? That's one person. I only know what I know. That's it. And that's why we're always very careful about saying, hey, be careful about what you hear, because I'm just one person. I'm just relaying information. And I'm glad you're here, and I'm glad you're enjoying the show and hanging out with me in the morning. I appreciate it very much. Click the like button. But you got to remember, the market is millions of minds and computers and algorithms analyzing all this data on a real-time basis. They are looking at Twitter feeds and Facebook and sentiment and all news headlines, and they're parsing everything. So the markets are factoring this stuff in just on a real-time basis, much faster than you can process it. So this is why it's always important is to understand the differential between what your views are and what the market is. And if you're way off what the market's thinking, this is where we've got to kind of reevaluate our positions. Now, eventually, one of those things could be a problem. I'm not saying it won't be. But normally, what impacts the markets and normally what changes that misconception back into reality is an unexpected exogenous event that nobody was counting on. And that's when you wake up in the morning, the Dow's down 1,000 points. That's when you need to take action. All right, wraps up the show for the day. Appreciate you joining me this morning. Be sure to go to the website, get our latest article. It's out. Send me your questions, comments, emails, whatever we do to help. Always happy to do it. RealInvestmentAdvice.com. Have a great day.